The US economy unexpectedly shrank in the first quarter, so how worrying a sign is that? US GDP fell 0.3% in the first quarter after the trade deficit reached its highest level on record with a 41% surge in imports. That shows American companies have rushed to stockpile goods ahead of tariffs kicking in. But has that trade data distorted the picture, or should investors be worried about a slowdown? Altaf Kassam is Europe Head of Investment Strategy and Research at State Street Global Advisors. Altaf, what does this front-loaded demand that we've seen in the first quarter mean for the next quarter?
What we're hearing and what we're seeing is that there was a massive amount of imports that came in to get ahead of the tariffs. So frankly, this data, which is backward looking by definition, doesn't tell us a whole lot about what's going to happen next in an environment post-Liberation Day, when everything has changed.
Does that mean then we should expect a sharper demand cliff since importers have already stocked up?
Yeah, it does feel like we could get even more bad news, if you like, because exactly like you say, that inventory has already been built up, so it's not going to be produced anymore, so GDP should be weaker. Obviously, there's loads of other things going on at the same time, so it's not just all about goods and demand. There's services and there's the tariffs as well. So it's going to be a complicated picture, but the rear view mirror is even less useful than usual right now.
Amid a complicated data picture, as you say, of course, the US jobs report is out tomorrow. How much do you think it might show this uncertainty filtering through into hiring?
Again, because it's looking backwards, I think it'll be hard to see a lot of that uncertainty. It's hard to remember now, but the market was pretty euphoric post the Trump election and Inauguration Day. So I think hiring plans were still pretty strong until maybe the last month. So again, backward looking, hard to make anything out of it. There's a lot of sentiment data out. Economists trust that less. So I think it's going to be a question of taking the data kind of point by point and seeing how we go.
We have a Fed meeting next week with slowing growth and higher inflation, and as you say, a difficult picture to read. Are they going to have to pick which of those problems they deal with?
Yeah, it does feel like, especially with all the noise coming out of the White House, the Fed has got a difficult picture to deal with. It feels like, unfortunately for the interest rate market, that inflation is probably going to trump employment. So it's a more worrying inflation picture and less of a growth problem at the moment. And so I think it's unlikely that the Fed cuts rates at the next meeting, but we'll be looking to June to see whether some of that demand destruction comes through, pulls down growth, and leaves the Fed a bit of room to cut.
What data will you be looking out for in particular when trying to work out if that might happen?
Yeah, I think we're going to have to stick with the soft data, even though economists don't like it as much. So we'll continue to look to survey data on business optimism, on confidence, on hiring, and see if we can piece together some stories about what is actually happening with the economy. And of course, we'll be looking at all the negotiations that are happening around tariffs, and if they come through, if there's an extension to any kind of reprieves. And so, like you said at the beginning, it's a complicated picture and lots of things to look at.
Do you think then that investors should be focusing on the slump in consumer confidence in particular, where we see this weak sentiment before, of course, tariffs have really affected what Americans are actually paying in shops?
It does feel like equities in particular respond to sentiment. And so this slump in consumer confidence, like you say, should be a drag down for equities. Now, we've had a reasonable results season, and particularly the large cap tech stock seems to have done okay. So I think that will add a bit of strength now back to the equity market. But it does feel like this confidence collapsing, not just for consumers, but also for corporates, is definitely the key to the future of the equity market, whereas monetary and fiscal policy is more what we would watch for the fixed income market.
Amid consumer-focused companies, though, we've seen quite a few reporting and being very hesitant to offer any guidance at all. What do you make of that?
Yeah, I think that's reasonable, to be honest. So we're in an unfortunate position where, like I keep saying, the rear view mirror is much less helpful even than it usually is. And companies are reluctant to give forward guidance because they're saying, well, the whole world has changed and we don't know what the outcome is going to be of tariff negotiations and so on. And so we are in a very, very sticky position right now where it's hard to look back and learn anything about the future, but we're not getting much guidance either from company executives or from kind of central bankers as well.
That was Altaf Kassam of State Street Global Advisors. Don't forget, you can watch more videos on Reuters.com.